in the test car model, we used a simple growth perpetuity formula to estimate the continuing value. With this formula, we are effectively assuming that the company will continue to generate its current return on invested capital to infinity. This assumption will result in an overvaluation if the return on invested capital declines in the medium to long term. For example, if you are valuing a tech company that has established itself in a new industry, the current return on invested capital may be very high. But as the company and the industry mature, opportunities will become more scarce, and the return on invested capital that the company is able to generate on new investment may decline compared to the return on its current asset base. In this case, estimating the continuing value using a simple growth perpetuity will likely result in overvaluation, because the return on invested capital on its investments in the future will certainly be lower than its current return. In this case, the key value driver approach is more appropriate for estimating the continuing value. The key value driver approach is cash flow based, and it links cash flow to growth and return on invested capital. This is the equation for the key value driver perpetuity. The continuing value at the end of the forecast period is equal to NOPLAT, where NOPLAT is the after-tax operating profit in the base year, multiplied by 1 less G, where G is the expected long-term growth rate in revenues and cash flows, divided by RONIC, where RONIC equals the return on invested capital for new investment. Remember, the return on invested capital on existing investment is effectively captured in the free cash flow in the base year, or the NOPLAT figure. All of this is divided by the WACC, which is the weighted average cost of capital based on the long-run target capital structure of the firm, less G, the growth rate.